Well, welcome everybody to the Clear Vista Financial Perspectives, our monthly market update, and trying to update you on the markets and what's going on with the economy and different things like that. I'm Mark Trice, financial advisor. In the studio with me is Jesse Hamilton, as always.
Hey, listeners, welcome.
And we appreciate you being with us today. I'm going to turn the camera off so that you can see more real estate on your screen for the presentation. Well, it's been a very interesting month this month. I'm going to, in just a moment, let Jesse begin to talk about the market indexes and things. We still had, for the third month in a row, we had the market's overall indices decline. And that was really driving on a lot of different things and a lot of information. So Jesse, why don't we go ahead and jump in here? If I can get the slide to advance. There we go. So here's our agenda for today.
We'll start off as normal with the October index performance. And then, of course, we'll take a look back over the last couple of years to see what has been going on ever since. And we'll do a macroeconomic update. We'll definitely talk about the Fed meeting yesterday and what happened. And then we'll answer your questions. So if you have questions now or later, anytime during the program, we would love to hear them. Two options here for you: info@clearvistafinancial.com for email, or we even prefer that you text us at 254-282-0495.
Okay, well, let's jump in here and start talking about some of the indexes this week.
So we'll start with the S&P 500, which is the 500 large cap companies in the US by weight. And that index was down 2.16% in October, but it had quite the dramatic swing. Mark, it was from peak to trough minus 6.60%. And that low there last Friday, we'll be talking about in detail what exactly that means. But pretty dramatic move this month, but overall close to open throughout the month minus 2.16%.
Okay.
Next up is the NASDAQ 100 index, which is a tech-weighted index. And it does not have the financial companies in it, which is kind of interesting. But this index was minus 2.87% in October of 2023. And it fell peak to trough minus 8.53. And what's interesting about this index is it contains what has coined the Magnificent Seven, which is the 7 tech companies that we all use almost every day. We're all very familiar with them, but they had quite the run up earlier this year, and they're starting to show some weakness in October. That really started all the way back in September and August. Next up is the Russell 2000 index. This index was minus 6.91% in October, and it was minus 8.78 peak to trough. This, of course, is the 2,000 small cap companies in the US, and it's important we're going to talk about in a minute why this index is different from the others and why it's not leading the way like we'd like to see it.
Yeah, and this has been a concern for us because usually when you're coming out of a bear market environment, small caps usually lead the way. And when we go back and study every other bear market that we've had for the last 100 years or so, when that bear market is over, small caps lead the way. And I don't know, Jesse, I don't know if we've got a chart on this or not to show that divergence, but starting really in February, we saw small caps just completely diverge from the large caps. And that was very important to note there with that.
Yeah, so last up, of course, is the long-term Treasury index. and this is the longer term treasury bonds issued by the federal government. That index was minus 5.76% in October, and it swung minus 6.84 from peak to trough. But what's really interesting here is it closed below the October 22 line last month in September, and it continued to fall all the way to this red line that I've drawn on the 23rd of October. And what's amazing here, Mark, is that level can go all the way back to 2002 for this index.
Right. And that's really concerning because when you have the rates for borrowing money going up so fast, that really contracts what business can do with their funds. And so this is going to continue to be a headwind. Now, in the last couple of days, we've continued to have those yields fall back a little bit, but there are some that argue that that will continue to rise again with this.
Right.
And for a longer term perspective, last year, long-term treasuries like this actually went down about 40% at one point. They ended the year minus 30, and then they are now down even further, about 15% year to date. And this is concerning, and we'll talk about this in a moment, but it's concerning because so much of most folks' portfolios, if they're nearing retirement, are in some type of treasury bonds or bond indexes, and those continue to fall. And in some cases, the typical 60-40 portfolio, that has really fallen a lot. So that's important to kind of, if you're not working with us, you need to make sure that you're paying attention to what's going on in your portfolio. And we'll pause here because we have disclosure. You put that disclosure back up. Did you put it back up?
Yeah, these are our indexes.
Yes, our compliance department thinks that we need to explain these a little further, but it's just these are different indexes mirroring a basket of stocks. So let's go back and look at the S&P 500 on a 2-year basis.
So here's a 2-year look back on the index, and you can see the high in January of 2022. That's kind of the peak of the chart there in the middle. And then you can also see the low in October of last year. The horizontal line that I've shown in this chart goes all the way back to April of 2021. And the vertical line, of course, is where that price was last seen. But you can see really the full movement of the index and how last year was such a challenging year. And this year, we're beginning to see a little bit of a turnover.
Yes. And we'll talk about this more in just a minute, but some think that it's a new bear market. We argue that it never was. The old bear market never really went away.
Right. So here's the same chart for the NASDAQ composite. And in this case, the current price can go all the way back to December of 2020. October was a significantly down month for those Magnificent Seven that have pushed up this index this year.
Right. And we've seen this peak to trough here. In some cases, pull back about what? How much? Over 10%.
Over 10, close to 15.
Yeah, just since the end of July.
That's right. So this chart shows the S&P 500 equal weight index. So it's the same companies as the S&P 500, but each company gets an equal vote. So it's like the House versus the Senate here. It really shows the greater story of market breadth and what's happening across all these large domestic companies.
And what this shows, Jesse, though, is it shows that the equal weighted index has really gone nowhere.
Right.
Year to date, you've had a lot of volatility, but it is currently below, at the end of October, it's below where it started in January of this year.
Correct. It's actually negative year to date. And the box that I've drawn is what we call a trading range that this index is struggling to break out of. And it's, of course, trending down. And this price goes back to March of 2021.
So this is one of our charts we look at on a regular basis, just to try to see what's going on with the overall health of the market. And this shows that this is showing the percentage of stocks on the market and they're tradable in the market that are above their 200-day moving average. Now, generally, that 200-day moving average is seen as a sign of a strength, and it's bullish for the markets if it's above it. On this particular one here, what we're seeing here is at about 27% or so at the end of the month that are actually 27% of the stocks, meaning that 73% of the stocks are trading below or in a bearish position on the stock market. So it's important that we're losing that momentum that's there in the market. Now we'll talk about if that's going to change any. But
the last time we saw this, Mark, was actually the middle of 2022, and we know what was happening then.
Right, and the market sold off even further that year. Now, are you saying that's going to happen? No, not absolutely not. We don't know, but we're saying that the data is resembling something that we've seen in the last year or so.
So back to the S&P 500 for a minute. This index closed at 4117 on Friday, and that's 10% below its recent peak in late July.
Yeah, and that's you've highlighted that with the red box around that close there. Now it's gone up the last few days, but that's really telling that's correction territory when an index or a stock declines more than 10% of its most recent peak. If we go back and look from where we are, where we were at the 1st of January in 2022, we are still well off those highs. And this is, some are saying that it's a brand new bear market for stocks. And yeah, in this view, there was a bear market in 22, and then a bull market from October to 22 to July of this year, and a new bear market that started in August. We don't think that's the right way to look at it. This is not really a new bear market. It's the same old bear market that started in January 22. We had a bear market in 2022. We had a temporary rally starting in October, and then the bear market reasserted itself. So it's important to kind of put this in perspective. And the driving forces behind the ongoing bear market have not changed. There's federal policy of easy money and extremely loose fiscal policy during the COVID years, kept a serious recession at bay. Yes, that's true. That's basically over now. Now the M2, the money supply, which we'll show in just a moment, is down over 3.6% in the last 12 months. Second thing is that the massive episodes of COVID-era government spending or stimulus, they have to wear off eventually, and that's what we're seeing in the last several months. But that's really revealing lots of malinvestment and are now generating those economic headwinds. We believe that much of the headwinds from these factors that we're facing are shifts that are still out in front of us. We haven't seen them yet.
Right. So we'll take a pause here and remind you that if you have any questions today, please text us 254-282-0495. And our email is always available, info@clearvistafinancial.com.
Well, Jesse, let's jump into the macroeconomic outlook here.
And of course, we'll talk about the interest rate decision yesterday, and we'll examine the overall economy. Hopefully we'll gain some perspective here.
Okay, well, let's dive in.
So what happened yesterday?
Well, Uncle Jerome, the chairman of the Federal Reserve, Jerome Powell, the Fed released their minutes. They left the rates, the overnight Fed funds rates, unchanged for the second meeting in a row, or as they refer to it, as a pause. But it was not clear from the press conference as to whether or not they're done with rate hikes or just simply at another pause, and that future rate is yet to be determined. The Fed statement yesterday was itself just mainly a repeat of September, with some minor changes in wording. One thing that was note that the economy is growing at a strong rather than a solid pace, which they mentioned last month or in September.
Exactly what words he uses.
Exactly. Words do mean something in this case. And then he said that employment gains have moderated rather than slowed. Now, slowing employment gains and rising unemployment were two key factors that the Fed was looking for. And that has changed. It's changed. It's really kind of a detriment to what they're trying to do. And really, the only new information came with the addition of the word financial conditions to previously noted credit conditions as factors weighing on household and business activity. So at the press conference, and Jesse and I watched this in great detail every time the Fed meets, Chairman Powell noted two primary factors that seem to be weighing on the Fed's decision-making process as to whether to raise interest rates, lower interest rates, or leave them alone. The first is the tightening in financial conditions, because the market has pushed up yields or rates on bonds higher in the last few months quite dramatically. And so everything from mortgages to corporate borrowing are going to have an impact on activity, business activity moving forward. The second item that he noted was, and it's a related factor, is that the Fed thinks that the full effects of their policy actions in the past have yet to be fully felt.
That's a big statement right there, Mark.
It is. And they're waiting because they're trying to have a balancing act here, Jesse, that that they don't want to overshoot or raise rates too fast or much more and kill the economy. They're trying to keep this balance between inflation and employment.
Right.
And that's still waiting. We think that the Fed's probably looking at the wrong things. Some of the things they're looking at are correct. We think, and they never mention this in every meeting in the last year and a half, they never mention the money supply. And this is what we're seeing here. This is from the federal government, the St. Louis Fed, the St. Louis Federal Reserve. We think that they should be looking at this. This is one of the main reasons that inflation took off. Everyone blames COVID and that it was the COVID shut down all the ports and things, and that certainly was part of the equation. But also, we pumped $11 trillion into our economy during COVID. And that money greatly and rapidly increased the money supply. This is the amount of money that's circulating in the economy. And this goes back to 1960, but in the last year, it's fallen over 3.6%. This bottom chart is showing that. So it looks a little bit more dramatic. But that shrinking money supply is going to start having an impact on the economy. The M2, this is the measure of the money supply, has declined in 11 of the last 14 months. As I mentioned, it's contracted 3.6% in the last year. And moreover, it's down 4.4% off the peak in July of last year.
Which is right here.
Yeah. Meanwhile, we got banks and commercial banks, as well as their industrial loans, are both flat to down. This is tight monetary policy, but we're not sure what tight means, because the Fed talks about something different, and we think they're not looking at all the right data for this. Now, I'm not on staff for the Federal Reserve. I'm certainly not a Federal Reserve chairman or president of one of the regions, but it just remains to be seen how quickly these reductions in money supply are going to translate into inflation, getting back to the Fed's target of 2%. Now, granted, I will say that the Fed's actions have gained some traction against the inflation problem. And I think, given a little more time, that this can be accomplished. But the Fed's got to remain patient here. It's got to stick to its mission to balance these things, the inflation and employment and so forth. I think one of the biggest risks in the year ahead is the Fed jumping the gun on cuts. And if economic conditions deteriorate.
So we always like to look at the yield curve to determine some perspective on the interest rate environment. The one that you're looking at right now is from December at the end of 2022. And you can see the bottom axis is the time frame. So the first one here is 1 month, 2 month, 3 month, and it goes all the way out to 30 year. And let's compare that really quick to what happened at the end of October.
That yield curve is inverted. And
That started in March of last year.
Right.
So we're
That means
20 months of a inverted yield curve.
that's right. And just as a reminder, everybody, the inverted yield curve historically has been a precursor to a recession. Now, you'll see some slides in a moment that some think that we've already had the recession. It just didn't get measured by the government. This really we think, because a lot of leading economists think this, that control the headlines that say that this one's different, but we're going to have to wait and see. And you'll see the 4-month yield is around 5.62%, while the 30-year yield is just over 5. The 10-year rate is closely related to borrowing costs for many American consumers, and it's above the 4% mark, right around about 4.8%.
Yeah, the headlines last week were talking about a 5% 10-year mark.
Yeah, and it did briefly hit that intra-day, I think on Friday is when it was, but that simply pulled back a little bit. Just to give you some idea about how these rising interest rates are affecting the economy. This is every Fed funds rate tightening cycle for really the past 50 or 60 years, okay, going back to 1963. The red line is the rate hike tightening cycle that we had in 2022 through today. And you can see how much more dramatic and steep rates were risen or raised in a very short period of time. We've never seen that before. And it's going to potentially have a drag on the economy at some point. But, everything's not all bad news here, because, the GDP report from last quarter was
on fire,
which we understand. We understand the consumers are spending a lot, but they're spending money they really don't have in the future. Credit card debt was up over $1 trillion for the first time ever. So we know that they're still living beyond their means. But you don't want to get quite used to that. Almost every economist is saying that the growth rate going forward is going to be much, much smaller. A lot of this has to do from the pent-up demand that was a result of us being locked down with COVID. The real GDP is really up 2.9% from a year ago, and it was really led by consumer spending. And that was growing at a 4% rate, consumer spending was. So, the economy was bolstered by a faster pace of inventory accumulation, as well as an ongoing surge in government purchases. We like to focus on core GDP, which includes consumer spending, and businesses purchasing fixed investments, and then home building. Now, when you take out the government purchases, inventories and international trade and all that stuff that are very volatile from quarter to quarter, that core GDP increased at a really reasonably healthy rate of 3.3% in the third quarter. Now, all these are annualized rates. That doesn't mean that it went up 3.3%. It just means if you repeat that 4 times, it will add up to 3.3%. However, not all the GDP news was good, and we still think the U.S. economy is still headed into a cooling off period sometime next year. So why take on more risk when companies can earn a solid return in saving in low risk securities? Well, that's a good question, and we're gonna show that in just a second in the next slide. This comes from an economist that both Jesse and I know very well, Jerry Boyer. He is the economist for Kingdom Advisors, an organization that we're part of.
He's also a biblical scholar too.
Yeah, he is. So this is basically showing a number of different things, but it was showing that
this is the GDP quarterly change as a percentage, annual percentage, and you'll see 2022 right here, quarter 1 and quarter 2. That's what we're talking about, where that was the technical definition of a recession, and the headlines and the politicians and such decided that it wasn't a real recession
because they were looking at a different version of GDP. So could the recession have passed? Maybe there's a double dip coming. Who knows?
Yeah.
So
one of the reasons that we see this decline, you'll see the last 4 candles, they're declining. Even though they are strong, they're declining. Companies are struggling to fill their shelves with products. So Let's go into a little bit more detail. We talked about inventories. Why is inventories so important to businesses?
Well, it allows them to be able to respond to demand.
Right.
And what's happening is we're seeing that companies have contracted their inventory over the past 18 months or so. There's a cost that every business has,
right,
of having inventory on the shelf waiting to sell.
They had to spend money to put that inventory.
That's
on the
right.
shelf.
There's an opportunity cost of this holding that inventory, and that's the interest rate. So if I look at this a little bit differently, the interest rate is the cost of waiting. In other words, we saw earlier how rates are higher than we've seen in decades. Now, reduced inventory happens because businesses spend their cash to make or buy products to put on their shelves. The other option for these businesses is just to put their cash in an interest-bearing account and get something close to 5% return. Now Jesse, I'm going to put you in as the role of the CFO.
Okay.
Your job is to make sure that the company makes the best use of its money. Which would you rather do?
I don't know. It's a hard decision when you can get 5% on your cash.
That's right. But what about leverage businesses, people that borrow money to make products?
Meaning a lot of these tech companies that are in the NASDAQ and such.
That's right. It makes it very expensive for them to make products when you're leveraged that way.
Right. Look what happened in 2021 and 2022. These inventories, this chart shows the actual shelf inventory of businesses. And they had all this time and money to fill the shelves. And then at the end of last year, look what happened. It went down significantly. And then this year, we're hovering right around zero in terms of change.
Well, I don't want to get, too wonky here with this because it is a little bit dry, but this is just showing why businesses are struggling to grow right now.
Right.
All right. So how does this impact you? So the GDP, the gross domestic product data is roaring, right?
Uh-huh.
And the market's correcting. So what does it all mean? Well, we don't have a crystal ball to tell you what's going to happen in the future because we don't predict. We don't make assumptions about our portfolios, client portfolios, by talking about what we think might happen. But we know that all these conditions that we've been talking about have led to a recession every other time in U.S. history. So let's talk about strategy going forward here. There was an article this last weekend in the Wall Street Journal. You may have seen it, and it explained how for the last 4 decades, investors have been able to stomach these bubbles, crashes, and politics and other chaos by holding the traditional formula of stocks and bonds. This strategy isn't going to work like it has in the past. So if you're not working with us or you have your 401k at work and you put it on to set it and forget it in a target date fund, you are struggling, and you may not realize it, how much you're struggling with that portfolio. That traditional portfolio of a current retiree or near retirement is a 60-40 portfolio for a lot of people. When you have long-term treasury yields that are the highest in almost 20 years and stocks that are pricey, these create tremendous headwinds for your portfolio. And let's add to that, federal debt held by the public grew from less than $5 trillion before the pandemic to more than $21 trillion in a decade. Meanwhile, overnight interest rates, they were all pushed down because that was stimulating the economy to near zero, and they stayed there for over a decade until really early 2022. And then you add in the popularity, Jesse, of retail and meme stock investors, and you get a picture of how we got to this point in 2023.
Right.
So this chart is from that same Wall Street Journal article. Investors are facing a similar situation in the mid-1960s with a typical 60-40 portfolio that moves sideways from the early, this is going back to 1966 through 1981, where investors saw that 60-40 portfolio move sideways until 1982. That's the light blue line on here. Compared to the dark blue line, when we had a 40-year period of falling interest rates, did those portfolios do well? We have the conditions now in the bond market, in the economy, and the stock market are more similar to the 1966 to 1981 period than they are to the last 40 years.
Correct.
And that's very important to note because we think this may continue for some time. Let's look at the long-term Treasury index. This is going back to 2019. And I should put this on the screen, but the camera, we're turning it off right now. As yields rise, the price of a bond drops. So as the interest rate rises, the value of the bond drops. And this is the dramatic change that makes up something of 40% or more of your portfolio if you're working with somebody else. So we just want to point this out. And it's so important to make sure that if you're not working with us, that you talk to somebody who can help you with these things. Now, I don't know what other advisors are doing. I don't care. I know what the economy is doing right now. I know the headwinds that we're facing, and we manage that risk accordingly. The last 3 months have been very tough in the market, but there are still opportunities ahead of us. So I showed this chart. Well, Jesse showed it last month.
Yeah.
It was in a letter that was mailed out to our clients as well. This is a selection of different bear market periods over the last 90 years. Well, what I want to focus on here is the time to get back to the previous peak, okay? And that's very telling. The tech crash, bear market, that took place in 2000 to 2002, it took nearly 17 years to get back to even because you really had two bear markets in there during that period of time.
Right.
Let's go back to the great financial crisis in 07 to 09. Many of us remember that. The S&P declined 56%. It took 5.5 years almost for the S&P to recover. Now, in this latest bear market, I think personally, this is my personal opinion, I think we've seen the bottom, but we don't know how long it'll take to get back to even. Now, a lot of people say, you know, if you were an investor in a mutual fund or ETF that tracked the S&P 500 from March of 2000 to 2013, you made nothing excluding the dividend. The value of the index did not move higher over 13 years. So what about the losses during those periods? How much loss in value, Jesse, do you think you would be willing to tolerate? Is it 27%? Is it 56%?
On your entire retirement savings?
Yes. And most of it, investors would say, hey, no, well, not that much. So should we invest in the indices? Well, you can, if you've got the time to wait and stomach to tolerate the ride. That's why we prefer to manage your portfolio with technical analysis and active risk management. Folks, there's no system of money management that is perfect, but we feel that our approach helps mitigates losses and navigate these volatile market cycles like we're in now. So what's the solution, folks? This is a big question that everybody wants to know. We here at Clear Vista Financial, we don't like the phrase, this time is different. Oftentimes it's used to justify why we should ignore market and economic data that are flashing warning signs. So many investment professionals are refusing to adapt to this stark reality. We're adapting to this dramatic shift, and one reason why we choose to manage our client portfolios with technical analysis and active risk management. This month's presentation may seem a little bit negative, but we're not trying to scare anyone. We still believe there's a bright future in the United States. You know, entrepreneurs are innovating. They're still creating. Artificial intelligence shows great promise. And we are very hopeful that sometime in the next few decades, there will be a major technology breakthrough in the energy sector. With that being said, we are hawkish, like the Fed is, and we are somewhat have a negative or a bearish view towards the markets right now. Does not mean the markets are going to go down, does not mean that they're going to go up. But we are extremely cautious about where the direction goes. That's why we're not in the prediction business. We are in the data interpretation business. And that means for your situation, for your portfolio, your financial plan, you know, there's things you need to be focusing on, you know, because we're in the middle of fall. We actually had cold weather the other day here in Central Texas. The Lake Waco filled up.
That's good.
In one day
Mm-hmm.
after being down 14 feet. So, you know, it rained pretty heavily last week. But we encourage you to take action on your financial journey. We're here for you to help you navigate this world of risk and financial planning. Recession or not, we're here to help you. So if you have any questions about your portfolio or your financial plan, give us a call. We'll share with you our contact information in just a moment. But, sometimes, Jesse, financial planning means being prepared for the unexpected things that could happen.
Right.
Our strategy has not changed at all. We encourage you to check your statements, talk to a professional, and educate yourself. Take time to find a professional that you trust to help guide you, because it seems like the headlines, Jesse, I don't know about you, really just cannot be trusted.
Right.
All right. So any questions, anyone, from those that are still listening and you haven't been bored by all the economic stuff? And if you're wondering, hey, did Jesse and Mark switch seats? Yes, we did, because we were trying to fix all the computer problems.
We got it working though.
You can send us a message anytime to 254-282-0495. That's our text line. You send us that text, we'll get back with you within 24 hours. Sometimes it's a little bit easier for us to just call you. But if you want to call us, you can reach us at these numbers here, 800-491-4508. I'm going to check one place, Jesse, to see if there are any questions on the question board. Don't see any on text right now, but let me check real fast here to see if there's some on the email inbox. Most folks send us a message later on after our webinars because they think of a question that would be good for them. So there's no questions on the board, Jesse. Folks, we want to thank you for joining us today on the Clear Vista Financial Perspectives monthly market update. Have a great day.